All right. Hi, everybody. Hi, good evening. Welcome to our live on a very interesting topic, which is direct versus regular mutual funds. And we have been receiving, oh, by the way, I'm Tashi from Lxme. And of course, we have Preeti Rathi Gupta, who's the founder of Lxme, with us, who is going to answer all your questions, whatever you may have regarding investing in direct or equity or direct or regular mutual funds. So I think this is a very hot topic. A lot of people have been talking about this. There's also a lot of unsolicited advice that's going on that, if you're invested in regular funds, you should probably move all your money into direct funds. I think it's really important to understand why should one invest in regular funds and why should one invest in direct funds. So to answer your questions, Preeti is here. Of course, we thought that it's very important for an expert to be here to answer all of these questions. So we're going to start with the live now. All your questions, please, we're going to be taking up live questions. A lot of questions have already come to us through our Lxme community. So yes, Preeti, let's begin. So I think I want to start with, first of all, before getting into direct and regular mutual funds, a lot of people have also asked, what are mutual funds and how should I choose the right fund to invest in?
Hi everyone who's joined in, and I'm really looking forward to this discussion because, like Tashi said, it's been a hot topic, and we have been, individually actually talking to women in the community as well as our investors. So great, Tashi, thank you for hosting this. And to your question, yes, of course, let's begin with the basics. What are mutual funds, right? Mutual funds are essentially a fund where all of us, a lot of people like us, put in their money and give it to an expert so that the expert manages that money, that pool of money. She or he will put it across, if it's an equity fund, depending on the kind of fund, right, will deploy that money into various asset classes. So whether it is equity or debt, or it's a mix of equity or debt, if it is a gold fund. So there are various types of mutual funds, various categories, but essentially it is pooling in of money by a lot of investors who actually want to put in small amounts of money, right? Who also want to begin with small amounts of money. And then your money is invested across, for example, if it's an equity fund, it could be invested across 50 different stocks or 100 different stocks. So there are two benefits of mutual funds. One, your money is being managed by an expert. And the second is it's getting diversified over a number of different instruments within that category, right? So it is also reducing your risk. And we all know that diversification, or putting your money across different asset classes as well as instruments, is a great way to manage your risk of investments. So that is what mutual funds do.
Great. All right.
And I'll just, sorry, Tashi, I'll just like to add on to this. Mutual funds are regulated entities. They are very closely regulated by the SEBI, which is the financial regulator in our country, as well as by an industry body known as AMFI. So they are very, very well regulated. So right from what category, what is the name of the category, to what is the cost that each mutual fund can levy, to what kind of assets they can invest in. All of that is very, very closely monitored.
Sure. So it's a great way of investing in when you're diversifying your portfolio. So apart from your traditional instruments, like we all have been investing in, right? And also like hearing about from our parents that, okay, do an FD, invest, save tax through a PPF. Of course, you should also have a chunk of money invested in mutual funds because they are market related, so they target better returns. Great. So now, Preeti, let's come down to regular and direct funds. So what are regular funds? What are direct funds? Are these different types of mutual funds? Can the same fund be regular and direct? And what are the pros and cons of investing in both?
Okay, yeah, let's dive right in. So every mutual fund company, for example, let's take a company like ICICI, will have various different funds, right? Now you can go directly onto the fund platform and invest with them, which is essentially any of the funds that ICICI might have. those are typically known as direct funds. The cost that you incur on it is essentially the AMC cost, which the fund already has incorporated within their cost structure. So the net asset value, or the NAV, that your mutual funds show you is essentially what it includes is just the AMC fee, right? So these are direct funds. Regular funds are typically when you go through a distributor, that is anybody who's advising you, or anybody who's the intermediary who's helping you invest across funds. Then if you invest through that distributor, then it is known as a regular fund. It has a small percentage of added cost, so your NAV comes down by that small percentage. Like I said, both mutual fund, the entire mutual fund is very, very well regulated. So these costs, even to distributors, which are given as commissions, are capped. At best, it is a 0.9% of whatever amount you invest. So that's basically the difference between direct and regular, which is why direct is known. It's simple, right? If you directly go to a mutual fund company, an AMC, and invest with them, it's known as a direct. If you go through a distributor, it is known as regular. Now, I think the big question is then why would anybody go through a distributor, right? If you can go directly to a fund.
Right.
Now let's try and understand. The mutual fund industry is very similar to how you would choose stocks, right? How would you choose a mutual fund? There are 2,500 mutual funds out there across various categories, right? So as an investor, you are making a decision on not just what category of fund, so whether you want to put it in equity, debt, gold. Within that category, for example, let's take equity. Do you want to put it in a large cap, mid cap, small cap? Do you want to put it in a growth fund? Do you want to put it in a value fund? So there are too many decisions that have to be made, and based on your goal and what time frame are you looking at. If you are somebody who can do all of that research and say, okay, now I can research across these 2,500 funds and then choose the fund that I need to invest in, then direct funds are for. However, if you want to sort of have hand-holding, somebody who can choose the right funds, research them for you, then that regular funds is what you will go to. Of course, the big piece that you need to pay attention to is if you're going through regular funds, your advisor should typically easily be able to give you or cover up for that 0.9%, right? That 1% every year additional return by way of researching and choosing the best funds in that category, right?
Right.
And when you say choosing the best fund, the sort of the research that goes into choosing a fund for you isn't just saying, okay, this fund has performed the best over the last 5 years, right? Because when you come to investing, sometimes historical data is good to use as a benchmark and say, okay, this fund has done really well, right? But there are finer nuances to it that you need to understand. How volatile has that fund been, right? So suppose somebody tells you, oh, this is a great fund. Over the last 3 years, it has given a 25% return, right? And you're saying, okay, over the last 3 years, it's given me great return. So why should I not just invest into it? But you need to try and understand that over the 3 years, how many times has that return gone to 30% and how many times has that return come to 13%, right? What is the volatility in it? What are the types of stocks that fund invests in, right? So there's a lot that goes into understanding, and therefore saying that historical is one piece, historical performance, but saying given the ratios that we track, something like Sharpe ratio, looking at the fund manager, looking at the stocks that are there, looking at how the economy is going to pan out, which are the sectors that are going to do well, you're also looking into the future. So your advisor should be able to look into that future, and therefore, the ability to give you that additional 1% every year is very, very easy, right? And then you don't need to research the markets. You don't need to know about, you don't need to study mutual funds. If you are doing something full time, if you don't have that ability, time, skill, all of that, then, of course, regular is the best way to go.
Right. So you could say in a way for, like say a first time investor or someone who's not keeping a close track on the market on a regular basis, that that margin in the return that the person gets because of investing in regular funds is basically the cost of convenience and the cost of expertise and the guidance that the investor is getting. And like you said, that if you're getting all of this, right, if you're getting the expertise, if you're getting the guidance, you may actually even cover up for that 1% with the right investment decision that you make.
Actually, you almost, so the beauty about, first of all, about mutual funds is that mutual funds itself can give you an alpha over the stock markets because you have experts managing it, right? And then if you have somebody advising you and saying, okay, amongst these mutual funds, amongst these experts, these are the funds that have done really well, the ability to give you a percent or two or even more is it's very, very easy, right? Because that's what somebody is doing for you 24 hours. Tashi, I can give you a very easy to understand example in this, right? Because there's a lot of debate about direct and regular. And like you said, there's a lot of people saying that, okay, if I've invested, for example, 1 lakh rupees, then I'm going to pay 100 rupees every month extra, right? Whatever. But if you have that and people are telling you that over the 10 years, you can save that much. But what you need to really understand is that if that 100, instead of that 100 cost, you look at the 200 rupees additional return that you can make and the compounding of that, I think that's where you need to pay more attention. And like I said, let me just give you a very common example, right? In our country, you have tea, which is sold at every price point, right? So you have the best of teas, you have like the cheapest of teas, etc. All of us, when we look at
tea, the best of teas are also the cheapest of teas most of the times. Yeah.
So I think what we need to understand is the way we choose teas, right? The tea that we consume is essentially saying, okay, let me find that balance between cost and taste, right? Which means that I'm trying to get tea, which either if it is little expensive than the market, then I use lesser amount to give me that flavor that I need, right? So similarly, whether it is tea, whether it is a spice that you're getting for your household, similarly in mutual funds, that's the sort of mindset that you need to have, that I'm buying something, I'm investing my money into something, and therefore I need to do that fine walk between what is the skill level I have, what are the returns that I need, and who's the best, what is the best option for me in terms of, that fine balance between cost and returns.
Right. Absolutely. I think I am invested in regular funds, right? And I understand why. But the people who have come up to me and questioned me that why are you invested in regular funds and why aren't you moving to a direct fund? Their very, very single-minded objective is that, hey, you're losing out on that return, right? You're losing out on that margin. But when I ask them that, okay, so what are the benefits? Why would someone invest in a regular fund, or what is the benefit? They actually don't understand. They just feel there is absolutely no benefit because whatever you are speaking about, right, the guidance, the expertise, etc. I don't think a lot of people understand that, and I don't think people understand the importance of that. I think one more thing that you potentially also get when you're investing in regular funds is rebalancing. Your portfolio is rebalanced routinely. So Preeti, would you also throw some light on that, please?
Yeah, so I think particularly on Lxme, because we have portfolios, we have baskets which are suited to your time frames, the time frame that you want to invest in. So we've shortlisted and we've chosen 3 funds, right? And also, first of all, it's important to understand that when you are investing directly, you are only associated or interacting with that particular AMC, right? You are not able to have a holistic view of all 2,500 funds, right? That's the first one. Second, I think when we've made these portfolios, the way we've chosen is we've said out of these 2,500, and for somebody like Lxme, because our allegiance is with the women who are invested with us, we sort of hold all funds at par, and then we look at them very, very objectively and say, okay, in terms of performance, which ones are more suited to the time frames that we are looking at, and we closely monitor these funds, right? And each time we feel either there is an event that occurs, for example, I'll give you a classic example. In just when COVID struck, right? Suddenly the credit risk funds came into a lot of problems because there was lack of liquidity in the markets. So companies that had borrowed, so credit risk funds are the funds which invest or which buy debt paper from corporates or companies, right? And suddenly there was a huge risk there if you had to withdraw your money because companies were facing liquidity problems. They must be great companies, but at that point in time, because there's a liquidity crisis, we are not, as investors, we are not able to withdraw, or we are not able to sell our debt fund investments, or withdraw money from it, right? Now that these credit risk funds came under a lot of pressure. Now today from Lxme, I think we were closely monitoring that that event, and we said, okay, this is what is really coming into a lot of risk. So this is the place that we need to get out of and come into a more safer debt instrument, right? Now that is very event based, and if this is something that an advisor brings on board, and to pay that small cost and on debt funds is as little as 0.5%, right, is really worth it, because you are actually saving yourself from risk and getting better returns as well. So that is one piece. On our baskets, I think, which is why we are continuously looking at rebalancing. If there is a fund that is, if the fund manager has changed, or the basket has changed, or we think the sectoral view or the sector that it is invested in has changed, then we advise, or we actually rebalance the portfolio. And I think this is very important, because otherwise you have to constantly keep a track. A lot of people actually also say, Tashi, that, oh, I'm, on this platform, they tell me which is the best fund for the month, which is the best fund for the last 3 months,
top 3 picks. Yeah. Picks, right? Different parameters. Yeah.
Now, I think it's important to understand, if you just closely look at those, you'll see month on month, or after 6 months, if you see the top 5 funds from the beginning of 1 month, you'll see very few that have continued from 1 month to 6 months, right? And as an investor, you cannot be investing into a fund every month and removing your money every month. Funds come with an exit load also. So you should have somebody who's advising you that if you actually put your money in and remove it before, the exit load, till the period the exit load applies, you will actually lose that money of exit load also. So, just going by saying, okay, these are the top picks, this is where most of the people are investing their money, or this is the top fund, etc., is really not good enough for an investor who especially wants to stay invested for a decided period of time, even if it is 6 months, 8 months to 10 years. You need to have consistent investment without too much of churning, without too much of getting your money in and out, making sure you're not paying an exit load. So therefore, I think, at least in Lxme, because we have these baskets, we rebalance them. But I think anywhere where you go through a regular fund, you will have that sort of advice coming in, that, choosing the right fund, to saying, okay, this is the time that because you're also looking at a more futuristic scenario, as opposed to just the past performance, right? And you're saying, okay, this is my, if somebody's invested through Lxme, our viewpoint is, okay, she's invested with a mind frame of 3 years, and therefore the fund that we choose should be the fund that should be able to give consistent return over the next 3 years, right? And we're not going to advise you that, okay, now you invested for 3 years, but after 3 months, remove your money and put it into another fund, right? So I think it's important to understand all of these smaller nuances and the differences, why a regular fund and why a direct fund, right?
Right. All right. So I think as we're also talking a little bit about what Lxme offers, Abha has a question, and she's asked, how does Lxme choose the fund basket? So how are the different funds chosen under every basket that we have? For everyone watching, we have 4 mutual fund plans or baskets that we've created, and they're created keeping your goals and timelines in mind. So we have an ultra short-term plan, which is best suited for all your financial needs, which are under 1 year, so up to 11 to 12 months. We have a short-term, which is best suited for your financial goals between the period of 1 to 3 years. Then we have long-term. We have a long-term plan, which is best suited for a time horizon of over 3 years. So, this could be you want to plan for retirement, or you want to buy a house after 5 years, etc., whatever your goal may be. And then, of course, we have a tax-saving plan, which has 2 ELSS funds. So, Preeti, how do we really, from a technical point of view, right, because you're the expert, how do we arrive at the funds, the different mix of funds, the blend of funds that we have of debt and equity, arbitrage, liquid? under each portfolio?
Okay, so there are two filters, and Abha, that's a great question. So there are two filters that we use. One, like Tashi said, we look at time horizon, and when we look at time horizon, we do a sort of an asset allocation within the basket, right? So there is already an asset allocation between debt and equity. Now, what that does is, irrespective of what age you are, what stage in life you are, as long as you know that want to keep your money invested, for example, she said retirement, right? If your retirement is 10 years away, you would keep it in a long-term fund. If your retirement is 3 years away, you would keep it in a short-term fund. Based on that, what is the time frame? We've done some sort of asset allocation within each fund. For example, an ultra short-term fund typically for us means, and the reason we would want you to invest in ultra short-term fund is an proxy for your savings account, so that you have liquidity, so that you're able to immediately remove your money. That's where your emergency fund also goes in. And the way we look at it is really saying that, okay, let's put it into instruments that are safest, that are very interest linked, and also one instrument like an arbitrage fund, which is, although it is an equity fund, but it is, the returns on it are already locked in, and it gives you a slightly better return than debt funds, right? So that's how we structure. So that's the first filter. The second filter that we use is within each of these fund categories. For example, if in the short term we've made an asset allocation of having 80% into debt and 75% into debt and 25% into equity, the way we will choose these funds is essentially saying, okay, within equity, where do we want to put money in? Is it, now if it is short term, we know that we should not put money into any fund that is volatile, right? So therefore we choose large cap, or a large cap with a very small mid cap component in it, right? That's the sort of fund. Within that, now we have like hundreds of funds to choose from. So we use the fundamental analysis, we will do technical analysis. Then there are ratios like the Sharpe ratio, there's a Trenor ratio. So we use all of those to try and understand, like explain what has been the volatility, what are the stocks in it, how many times in the last 10 years or 5 years has the fund dipped below a certain return percentage, etc. And based on all of these, we actually shortlist funds. So it's a very, very wholesome exercise, which involves both historical as well as the futuristic view, using a lot of fundamental and technical tools. And that's how we arrive at which funds are best suited. And most importantly, we keep in mind that we are investing as women with the way women look at money. So for example, our risk appetite, the way we want to nurture our wealth. So, also saying that we, even if it is a long-term mindset, we know that, you don't want to choose very volatile funds. We want to choose funds which are very strong, are able to give stable returns. And we know going forward, given the fund manager or the fund's track record and the kind of stocks that they're invested in, that this is what suits our, the way we look at, or our investment needs or our financial goals.
Great. Thanks, Preeti. I hope that answers your question. So Palak has asked a question, Preeti, and she's saying that if, suppose she wants to invest in direct funds, where can she find the right resources to do her research and then invest her money?
Palak, there are lots of resources. You can go on to Google today. There is information overload everywhere. I think it's important to also understand what information you're looking for. I think one of the things that most people do is, and the quickest way people make decision is saying, okay, which are the top 5 funds over the last 10 years? Which are the top 5 funds over the last 5 years? Which are the top 5 funds over the last 2 years, right? And based on that, make a choice. I think my advice to you is that while that is something that you may use to sort of zero down on funds, but within those funds also, please do your own research. Please look at these ratios. Please use sites that help you with these ratios to understand, what has been the volatility. Is it all right? Because the point is, you don't, after 6 months, suddenly you see a big dip. Either you should know that this is how this fund performs, right? You see a big dip in NAV, you should know that this is how this fund performs. So you should know what you're getting into. Alternatively, you don't want to, after 6 months not knowing, want to, sort of remove your money, have an exit load applied. And, in this need to make extra or to save this little cost, you actually incur a higher cost of exit. So you have to know that you want to keep invested in a fund as long as possible and not keep removing your money. So using whatever is out there on the Google, on a lot of these sites, a lot of platforms which are direct fund platforms will give you, but please remember to do this little research on your own, because that is very, very important, because you are not going to be getting into and out of funds regularly. And also when you're directly invested, there is no holistic view that you are getting. So it's just with the AMC, and you don't have that 360-degree view of all other funds that are there. And I think one of the important things here, Palak, I'd like to also mention is that, look, investing is a very dynamic field, right? So we have certain categories of fund, but you also have newer categories of funds that come up. It is important to be able to get into a newer movement or something that we think has just come out, but it has got great potential, to be able to, start investing into it early. I mean, for example, ESG is one such field, right? Now, ESG is not a very popular term yet, but I think from Lxme's perspective, we have really been talking about ESG, and we've been researching it, and we feel that is one place that women should put their money in, because it meets our goals and needs, and it gives you an alpha over a long-term period as well, right? Now, these newer developments, newer type of funds, is something that to my mind, if you're invested directly, you might miss out on. So that is that one risk. But to answer your question, you can, there's information overload. You should know how to filter that information, do your own research on it, and then invest if you want it.
All right. Thanks, Preeti. So there's one more question that had come from the community. Basically, you've partially answered this, but if you could elaborate a little more, taking example of our model portfolios. If there's an unexpected performance by the fund recommended by Lxme under any portfolio, does Lxme guide its customers in that scenario?
Yeah, like I said, we will rebalance the portfolio. We constantly monitor. We are walking that very balanced view between making sure that we are not making you get out of funds or get into new funds every now and then, because that's something that we want to do, right? We want to keep our portfolios as stable as possible. But if we feel that there is an event, and you will see that in our, over our last 2.5-3 year track record, the only reason that we've made a change is because we've realized that there is a fund now that is giving you a better return. So our existing funds are also performing great. But the fact that we now see a fund that is giving you a higher return, which I come back to that 0.9% cost, right? If we are able to choose you a fund which is giving you a 2-3% higher return in the year, then we will recommend that, and we know that will continue to give because of the sort of strategy that it has taken. So we will rebalance your portfolio. We will get that fund in within your portfolio. So you have to do nothing. Once you're invested, your goal is the time frame, and Lxme's mandate is to give you the best return within that time frame.
Great. All right. So Shweta is asking, how much is the commission we are paying to the Lxme agents? Is it monthly or is it annual?
So, sorry. So, Shweta, firstly, we don't have any agents. We directly deal with mutual funds. So, all your money goes directly through the BSE to mutual funds. There is no agent involved. But when you use the Lxme platform, or when you go through to BSE through Lxme, the mutual funds pay us a commission. Typically, between if it's an equity fund, it's anywhere between a 0.7 to 0.8%, and if it's a debt fund, it's 0.4 or 0.5%, right? I do want all of you watching here to keep in mind that if you are going through a platform which is offering you direct funds, please understand, if it's a business, nobody's out there to do anything for free, right? It's not it's not a NGO. They will monetize whatever you are doing through some or the other way. It could be a fee that you're charging, or they are acting as affiliates, which means that you are actually they are actually lead generation platforms which they are passing on to third party financial organizations, right? So that is the other thing that you must keep in mind. Nothing is free in this world. So if ever if one is thinking that because we are going directly we are saving money, etc., trust me, you will be monetized in some way. I think at Lxme we are very, very clear that we are very transparent about it. We do a lot of homework. We do a lot of hard work in researching and giving you the best funds in creating that alpha for you. And I think what we don't charge you for it, but there is a certain commission that a very, very small percentage that mutual fund companies pays.
Yep. Thanks, Preeti. Shweta, I hope that answers your question. I think it's a very important question that you've asked. All right. Okay, guys. Any other questions? Please do put them in the comments and we'll take them up. I think this was a very interesting discussion. I hope all my friends saw this who have been questioning me and who also have been questioned on investing in. A very good friend of mine actually invests through the Lxme platform, and she called me and she was like, listen, one of my friends just called me and, he was saying that, why are you investing in regular funds and you should switch. And she was absolutely clueless. She was like, I don't understand, like, why is he asking me to switch and why is Lxme not giving me direct funds? So I explained to her the entire concept, and of course, I also asked her to, watch this live today. But I think people don't really think of, don't evaluate the pros and cons. They only single-mindedly look at the difference in returns that they're getting, and they're like, okay, if I get even 1% more over here, I think that is what I should go for. So I think this session was great, Preeti. Thank you so much. Any closing thoughts?
No, so Tashi, I agree. I think one thing that we usually sort of recommend in Lxme is pay attention to the return, right? A 1% additional return is great, right? It is something that you should aim for, but you should understand that what is the opportunity cost, right? So if saving that 1% cost, if you are missing the opportunity of making an additional 2-3% return, that is something that you must keep in mind. And I think, one of the things that I feel very, very strongly about is that I think, the proof really lies in the pudding, right? And which is the thing, one of the things that you must do is look at, the returns that Lxme has generated over the last 2-3 years. Vis-a-vis maybe, recommended funds by, say, any platform, any direct fund that you would have otherwise put it through, right? And if you see, and you will see that we've created that alpha over the last 2-3 years itself for our investors, then I think that is a good enough understanding of why regular and why direct. Direct is great for, I think, if you're investing, for the HNI investors, ultra high net worth investors who are investing 100-200 crores into mutual funds, because that is a huge impact cost in absolute terms, right? And today for them, I think it is all right to understand, okay, even if I'm putting it in, say, liquid funds, etc. Having said that, even for them to do that sort of research is just not possible. You have to have an expert who does that research. So bear that in mind. If you have that time, if you are really passionate about learning about mutual funds, if you're able to do, like I said, you should look at, a lot of, other than fundamental and technical research on mutual funds, you should look at a lot of other, ratios that are used in analyzing funds which are best suited for you. And if you have that time and bandwidth, surely go for direct funds, because then you should be able to create that alpha yourself, right? It is a lot like stock picking. But if you are not, then a regular fund will also, through an advisor, create an alpha. And I think that's, comparing the returns is the best way really to sort of have a very balanced view on this, that it's not just the cost, but it is also the returns that you need to take into.
Right. All right. Okay. Jyoti has one question. Hi, Jyoti. She's asking, how safe is it to invest in Lxme for the long term? Please don't take me wrong. I'm very new to this investments. No, Jyoti, that's absolutely, it's a very valid question. We're not going to take you wrong.
No, I think Lxme is a very, very safe platform, women, for all of you to come and ask, all of us to come and ask questions. And I'm glad you're asking this question, Jyoti. So one of the things that when you invest in Lxme, first of all, no money comes to Lxme. You just use our platform to directly give your money to the AMC or the mutual fund, right? So your money is with mutual funds. Irrespective of Lxme being there, not there, your money is invested in those funds. So there is no risk that you're taking in whichever way. And as Lxme, we don't handle your money. So it's completely safe for you. And like I said, the mutual fund industry is very, very well regulated, very, very tightly regulated. So, the chances of you really losing your money in mutual fund investments itself is not, as long as you're making a very sort of pragmatic, informed decision. But a mutual fund going completely, defaulting, etc., we've had a couple of cases, but I think that again, SEBI's really tightened that. So you're in safe hands if you're investing through Lxme. Lxme is here to stay, but irrespective of that, your money is with the funds. It goes through BSC. It is held under your PAN card, your account number. So there is absolutely no risk.
Yes, Jyoti, I hope that answers your question, and you can download the Lxme app on Android. The community is now on the app. So whatever questions you have, you can either ask them on our Facebook group, or you can download the app and ask all questions on the app itself. And you'll have thousands of women there to help you, along with, of course, our Lxme money coaches. All right. Preeti, again, okay, sorry, we have one last question.
And me too.
And Preeti, of course. And Preeti is going to be there on the community. Yes, on the app. All right. Nivedita is asking, what would be the minimum and maximum percentage of returns for equity and debt or any other methods of investing? I think that's a little broad question.
Yeah, that's a very broad question, Nivedita. But ideally, if you're investing in debt, currently you should look at a return between 6 to 8%. If you're investing in equity, that's very, very broad, because the returns are anywhere from 14% to 28%, depending on, remember, risk and return are tied. So if you're, there have been times when mid caps have given you great return over the last 6-8 months. So the equity spectrum is very, very large. But typically in equity, you could look at a return which is about 12-13% very easily.
Great. All right. So Dee has a question. How long does it take to redeem the funds in case of emergency once we go through the Lxme app? So I can actually take this up. So Surbhi, typically, because your money is invested with the AMC, right, which is the fund house. So it again comes back to your bank account, and this process, it's industry standard. It takes up to 2 to 3 working days. So that's the, T+2, T+3 is the max timeline that you can look at when you get your money back into your account. All right. Okay. Thank you everyone for joining us. If anybody who's viewing this session, or your, women in your friends or family circle, if you have any other questions related to investments, investing in mutual funds, regular versus direct mutual funds, anything really, comparing FD, PPF, mutual funds, anything under the sun when it comes to money, Lxme is your go-to place. We have a very healthy, very safe community of women where we come together and help each other out, ask, learn, share about money management. Yes, so please, we'll take up all your upcoming questions on the app.
Yes, please ask questions freely in a very, very safe space. We are here to guide you, help you. And Lxme, more than anything else, is a community of women like us who want to navigate this space of money management. We have on the community women who know nothing about money management, who are just starting that journey, to women who've done it for years and years. And therefore, I think you will find mentors, you will find guidance, you will find a lot of interaction. Money management is a personalized journey. So when you take in feedback from a lot of other women, you'll realize what is it that really works for you. And it is a way of learning. It's a great way of learning, the peer-to-peer conversation. So that's what we in Lxme, at Lxme, believe in. So we are by the women, for the women. Come join us, and we look forward to many more interactions.
Yes. Okay, all right. Thanks, everybody. Thank you, Preeti. Have a good night.
Thank you, Tashi, and thank you everyone joining in. Have a great Sunday tomorrow. Bye bye. Good night.
Bye.
Bye.